All right, guys. Today I want to follow up my last video. I'm going to use the same software that I did in the last video. And really, the focus of today's video is going to be helping you understand how distribution and tax planning strategy in retirement can help you with your overall goals. And in this video, I'm going to focus a little bit more particularly on how it can mitigate risk in your portfolio. Now, I'm going to take a couple steps to get there, but first, I'm going to reorient us to what we're seeing on this screen and what it actually means. So, to back up, when you get to retirement, you're going to have a series of accounts that are most likely going to generate income for you. And those different accounts are going to have different tax implications. So looking at our columns here, we have qualified dividends. Those are going to come in a taxable account or sometimes referred to as a brokerage account. And the way those are taxed are usually more favorable than ordinary income rates because it follows what's called the capital gains tax schedule. So that's either going to be at 0%, 15%, or 20%. So that's the qualified dividends. We also have Social Security, which a lot of Americans rely on to have some form of government pension money that's coming in. So there's a combined amount there, and the taxation of that is going to be predicated on other types of income that you are drawing in retirement, and we'll get to that in a second. And then here we have long-term capital gains. And that is subject to capital gains rates as well. A long-term capital gain would be you bought a stock in your brokerage or taxable portfolio for a certain amount. The shares were at a certain dollar amount. It has grown over time. You held that stock for 12 months and a day. And then as long as you held it for 12 months and a day, it becomes a long-term capital gain. So then the difference between what you bought it at and what it is now is referred to as a capital gain. So let's just start here because I can tell you, I want to show you how that itself can create some efficiency. So let's just assume here that I want you to understand how I got to this $10,000 number. So I'm going to assume that you had $250,000 in your portfolio, and that would be deemed cost basis. Okay, I'm just going to put CB. So that would be your cost basis. Now, let's say that that grew to 500,000 by the time you wanted to start taking withdrawals. So really, it's only the difference between those two that would be, I'm going to put CG here, capital gain. Now, how does that work when it actually comes out? Well, a better way to think about this is what percentage of your total amount is your cost basis? In this case, I gave an easy example. The answer is 50%. Okay. So in this case, if you just think about 500,000, what would it actually take to withdraw 500,000 from a portfolio at a sustainable rate? Let's just use the 10% rule. Sorry, 4% rule. So if you took 4% a year out of this $500,000, that would be 20,000. Okay. So that's how much you're actually pulling from the portfolio. And so here's what's cool. Remember that 50%, when they return this money to you, some of this is them returning money that you put in, that's called your cost basis, and some of them is them returning your capital gains. So if you pull out 20,000, 10K. That's where I got that $10,000 figure here. So when I look at a tax planning software and I have a $10,000 capital gain, assuming that this is being used for retirement income and distribution, that doesn't mean that you only pulled out $10,000. It means only $10,000 is taxable to you. Now, the good news about that is that means the other 10% is essentially tax-free or it doesn't flow over into your taxes. That would be considered a return of cost basis. So that's kind of where this 10,000 came from. And I want to talk through the IRA piece because this is really important. So part of the reason you want to look at distribution strategy and tax planning year to year in retirement, there's really two reasons. One, you need to view this as a year to year decision. And two, you need to view this as a lifetime taxation decision. Now, many people come to me and I meet with them as financial planning clients and they say, um, I want to do this for this year. That's great. but we need to think about what is your overall lifetime financial plan going to call for, meaning what would be the way to limit your taxes paid over the entirety of your retirement period? That could be 20 years, 30 years, some people 40 years. So this is why it's important. So there's really two sides to this coin. One is you are saving prior to retirement in these different retirement savings vehicles that are then going to be distributed in different ways. So let's kind of move on to the IRA. So just to kind of remind everyone here, this number here, again, this is just a number that could represent what did you actually pull from your retirement account. In this case, it's an IRA distribution. Now, that number is that number. Realize for the capital gains distribution, that number may not represent the full amount that was pulled. Now, for your federal taxes, when you actually start to do this number will be accurate. It will flow over completely. The only place that that will not be accurate is, again, this is a state by state decision. But if you are a retiree in the state of South Carolina, basically from a state perspective, $20,000 a year of your IRA distributions are not going to flow through otherwise, meaning you get a deduction for them. Now, that's not true at the federal level. So this is just speaking of federally. So here's why this is important. Say again, let's just use that same example. Let's say you have an IRA that's $500,000. And let's say you're following the 4% rule on that 500,000. So basically every year you're going to take out your 20,000. Now, this is where this planning and knowing how all this works together becomes really important. Typically, you would just pull out the 20,000, but if you're not working, remember, all the income that comes to you, it's net, meaning that you've already sent the money through withholdings for taxes. So a lot of people throughout the year in retirement, especially, are coming up with a number every year of what should I withdraw for my expenses. Now, the expense piece can fluctuate wildly, and some years might be more expensive than others. But what I find often is we get to the end of the year and I realize that retirees are over withholding for their taxes because they don't quite understand how it all fits together. So here's where this is going to be really beneficial to put all of these together to know how they are, how they work off of each other so that you can accurately withhold. Because remember, this is a double-edged sword in retirement. Not only are you withholding, but every extra dollar that you take out over $20,000 will essentially increase what's called your portfolio withdrawal rate. So if I were going to put a withdrawal rate on that 20,000, it'd be 4%. But if I said, basically, I want to take $20,000, sorry, $20,000, but I actually need to withhold at 20%. Okay, that means I have to actually take out 25 now. Because remember, I've got a tax bill at the end of the year. So now all of a sudden I've got to take out 25,000. And if we just do the math here, now all of a sudden I went from 4 to 5, right? So why am I making a big deal out of this? Here's why. You may say, hey, 4 to 5%, that's not a big deal. Well, here's why it may be important. Okay. It's because there's something called sequence of returns risk. Okay. And basically, when you get to retirement, sequence of returns basically says a lot of times we can have a guess of what your returns are going to be over a 20 to 30 year period. Again, we can never guarantee returns. This is not me saying that we can, but if you have a certain allocation of your assets inside your portfolio, we can say in the last, backward looking, we can say this might earn somewhere between 4 to 6% or whatever it may be. But what we don't know is what will the returns be? So for example, if you retire in 2025 or 2026, we don't know what the returns for this year are going to be until they actually happen. So we could have a down market of, let's say we go down by 18%, and the following year we go down by negative 10%. Now there's been lots of research about what this actually does to a portfolio, and the sequence actually matters. So you are less likely to have a positive outcome if the beginning of your retirement period involves multiple negative years. Now, there are a couple ways to mitigate this. This is only one of them. I don't want to present this as a one size fits all solution. One is going to be trying to be as proactive as you can in terms of where you allocate your withholding. So for example, let's say that you have, I'm just going to write a couple sources here on the whiteboard. Let's say that you have a pension, Social Security, maybe even an annuity. Let's just throw that in there. And you have an IRA. So beyond just the dollars and cents of, okay, I know what my total tax liability is for the year, there's a couple of these that would be more advantageous for you from a sequence of returns perspective to actually allocate your withholdings. So I'm going to circle a few of these. So let's talk the pension. So why would that be helpful? So a pension by definition is you've worked for a company, maybe in a government job, maybe it was a private pension, and they've said, we're going to pay you X amount of dollars for the rest of your life. Now, here's what's great. A lot of times they'll allow you to do tax withholdings out of that. Now, that would be more advantageous than doing your withholdings out of your IRA. And here's why. Because the IRA is subject to market fluctuation and the pension is not. So this may seem simple, but a lot of times I just don't think people think it all the way through. So it's something that me as an advisor has and can add a lot of value and have some good conversations around what's the most efficient way to do this. Similar for Social Security, right? So a lot of retirees have their Medicare premiums taken out of this, but you can also have your withholdings coming out of that because you know that amount. And not only these amounts might inflate, right? So some pensions inflate. If they're private pensions, they usually do not. Federal government pensions usually do. They have a cost of living adjustment. So does Social Security. So you're going to be taking more out every year, and you might as well withhold whatever your liability due is from there. Now, this leads to the conversation about the IRA. Again, bringing this back full circle, why would you not want to increase your withholdings? It's because it causes a higher portfolio withdrawal. Therefore, if you have a negative sequence of years, you do not want more being pulled from your IRA. So in reality, you want as little as possible withdrawn from that IRA to meet your needs. Now, this is strictly from a tax withholding perspective. Same thing goes for the annuity. I just wrote up there for clarity. So what does this actually look like in practice? So again, I have these scenarios here to demonstrate that even though you pull a significant amount of income sources, depending on how you're taxed, you may not have much of a tax liability at all. Now, this would be helpful for someone who said, I want to minimize taxes today. That's not always the case over a lifetime. So even though this looks great on paper and we say, okay, let's just continue to withdraw this year after year, if they have a smaller taxable account, again, that's where the long-term capital gains from, that's not going to last the entirety of their retirement. Then one of their income sources goes away. So then their tax planning situation changes. Same thing goes for IRA distributions. So they're only taking a small percentage of an IRA. Say this person has a $1 million in an IRA. They're choosing to only pull a little bit over 11,000 from that account, which is under withdrawing. Now, depending on the size of the IRA, that's a great decision the year of, but is that IRA going to double over the next 10 to 20 years? If so, your RMDs might be such that you have higher taxation later. So the answer every year is not always the answer for all the years and for the plan in its entirety. So hope that's helpful. So let's just talk through this scenario really quickly. And I'm going to change some of these numbers just so you can see. So for example, let's just say that we stick with our previous 500,000 and we go to 20,000 for an IRA withdrawal. Previously, we had no tax, okay, because of the way we were advantageously drawing. And this also assumes that there's a Roth moving in the background. So remember, Roth is always going to be tax-free. In retirement, subject to some other rules and regulations. You're older than 59 and a half, and you have satisfied the 5-year rule. So if we look at this, if I come down here, so now all of a sudden we have some tax liability. Okay, it's basically a little bit over $1,500. Not a big deal. So what you could do is, again, let's just assume this person now has a pension. All right, so I'm going to say they have a $15,000 pension. So let's add that to the mix. All right, so we have a $20,000 IRA distribution. We have a $15,000 pension. And let's just say, for the sake of just kind of evening this out a little bit and making it a little more interesting, let's increase our capital gains here to see that so this person's going to be withdrawing a little bit more from retirement. Okay. Now, how those capital gains are distributed, I already went over, but I just want you to see this. So going through our income sources here, we have qualified dividends of 10,000, an IRA distribution of 20,000, a pension of 15,000, gross Social Security, and this is, again, this is assuming a husband-wife couple. Now, one thing I want you to notice is because we drew our income in a different way, our Social Security just became taxed at the maximum rate. So that's something to consider as well. So notice that number basically represents, not maximum, it's almost, okay? So basically, Social Security can never be taxed greater than 85% of this gross amount. Okay, I think this represents just under 81%. So it's very close to being maximum. But if I look at our income sources, all of a sudden, our total income, now we have generated a tax liability. Okay, so even utilizing standard deduction, which is generous for retirees, we've still got this tax liability. So really what I want to talk about here is, say you have $5,763. We have to pay that over the course of the year. How are we going to do it is really what I'm asking here, looking at these different income sources. Okay. So what I would not want to do, again, I would not want to go from this IRA distribution of 20,000 to 25,000. That would almost cover the liability right there. Because remember, that would just open us up to a less favorable distribution withdrawal percentage. So what I would propose instead for someone like this is to take this pension, okay, and to potentially take the money out of there, and maybe even just withdraw more from a more favorable account, the taxable account. Now, here's why. Because if we look at this, their taxable income is only 82,000. So they basically in 2026 have the ability to draw more capital gains before they reach the end of the 0% capital gains bracket. So that would be a place where they can mix and match and figure out what's the most advantageous place to actually withhold that money to make that tax liability. So that's really all I wanted to cover in this video. I'd like to do a follow-up video and talk about why, when you may or may not want to consider something like a Roth conversion. That's if you have something like a large amount of pre-tax money in an IRA and you want to pay the taxes on it now to reduce your lifetime tax liability. So hope this was helpful. And I will continue to make videos here that I believe are practical and helpful in nature. And I would say, if you like this, please subscribe, comment, and I look forward to the next video with you guys, and I will talk to you soon.